Good morning, good afternoon, good evening to one and all. I'm Angie Redish, and I'm the chair today for the International Macro History Online Seminar. Today we're going to hear from Gaston Diaz, who's going to present the paper he's co-written with Nectarios Aslandias on the rules of the game without a central bank, the gold standard in Uruguay in the classical gold standard period. Before they start, a few rules reminders. I also want to thank Rui, Nathan, and Jamila for organizing the seminar. It's a great opportunity for all of us. And so rules of the game. Gaston is going to present. He'll speak for about 40 minutes. If you have questions, put them in the Q&A. Do not put them in the chat, put them in the Q&A. And if there's a clarification you need, put hashtag clarification, and I will ask that of Gaston during the seminar. Otherwise, Q&A will hold till the end of 40 minutes, and then I'll ask the questions that have been posted in the Q&A. We'll go for the hour, the usual hour. At that time, the official stop happens, but we can go for another 15 minutes if there are further questions and discussion for a more informal discussion. So thank you, Gaston, it's over to you.
Thank you, Angela. I'm going to share my screen. Thank you for that introduction. As Angela said, the paper is titled "The Rules of the Game Without a Central Bank: The Gold Standard in Uruguay." We changed the title a little bit from the title we had before that was circulated. That title said "The Rules of the Game in the Periphery." Now we decided to put Uruguay right in the title, and these dates, 1876 to 1914. This is because Uruguay was on the gold standard for this entire period, which is kind of a strange thing for a small peripheral country in the 19th century. So we study, gold standard adjustment in the periphery, and we use Uruguay as an interesting case study. For this crowd, I don't think I have to explain too much about the classical gold standard. Obviously, it was a monetary system common in the 19th century. Countries used gold as their legal tender, allowed the free import and export of gold, and then backed their banknotes with gold at a fixed exchange rate. And if you sort of met those three conditions, you were considered to be on the gold standard. And there was kind of a traditional view of how the gold standard worked, that it had kind of an automatic mechanism that maintained balance of payments equilibrium, and that this worked through international gold flows and the effects of those on the price level. So, for example, a balance of payments deficit would cause a gold outflow that would deflate domestic prices, shift spending from imports to domestic goods, and return the balance of payments to equilibrium. That was David Hume's price specie flow mechanism. If we add into that things like capital flows and a banking sector and central banks, we can have other kind of equilibrating mechanisms, especially the interest rate mechanism. Faced with a capital outflow, a country can raise its interest rate, and that stops the capital outflow or brings capital in and retains gold within the banking sector. And it was thought that central banks kind of actively did this, that faced with a rise in foreign rates, that they raised the domestic rates. Doing this following foreign interest rates was called playing by the rules of the game. And it was after the collapse of the gold standard in 1914, when economists went to kind of study how it worked, it was thought that this was kind of one of the behaviors that underpinned the smooth functioning of the system, that central banks played by the rules of the game, that this is part of what made it work. In the middle of the 20th century, economic historians began to question this idea that central banks systematically followed the rules of the game. And so one of the first ones was Arthur Bloomfield, who in 1959 published a study where he showed the balance sheets of 11 European central banks and showed that in most years, central bank reserves moved in the opposite direction as central bank credit. So for example, if reserves fell, credit would rise, which is not what you would expect if that central bank was following the rules of the game. You would expect, faced with a capital outflow, that it would raise rates and restrict credit. And Bloomfield proposed that perhaps these banks were trying to smooth volatility, to shield the domestic economy from external shocks. And since then, numerous countries' case studies have kind of confirmed this intuition. Central banks, gave a high priority to the exchange rate, to exchange rate stability, but they also tried to protect the domestic economy from external shocks when they could. And some more recent papers like Morris 2013 and Bezold, Monet, and Morris 2022 have confirmed this econometrically. They have some very nice multi-country databases. And what they show, especially the second paper, this paper shows is that when faced with a shock in the Bank of England discount rate, other European central banks tended to maintain their discount rates low. They didn't raise them a lot, and they allowed their gold reserves to be drawn down up to a certain point and indeed increased domestic credit. And so they would absorb the shock on their balance sheet and that way protect the domestic economy, avoid obliging the domestic economy to suffer higher interest rates. How could they do this? Several aspects of this period. The gold points, the cost of shipping gold between countries created a band around which the exchange rate could fluctuate before it provoked gold movements, international gold movements. Reserve management, European central banks tended to have large gold reserves, so they could allow them to be drawn down up to a certain point. Some other capital market frictions may have played a role. And then above all, their credibility, especially core countries, central banks had a very high credibility. Nobody doubted that in the end, they would do whatever it took to defend the exchange rate. So they could actually, in the short run, allow temporary deviations of interest and exchange rate variables without causing a panic. So this regards Europe. Almost all European countries had central banks. What about the periphery? Most countries outside Europe did not have central banks. In these countries, we find decentralized systems, multiple banks of issue, often private commercial banks, and it is thought that these systems imposed stronger discipline. So Alec Ford, a student of the gold standard, it's well known that he said monetary systems run by multiple commercial banks had less discretion than central banks and were more wholehearted followers of the rules of the game. So they didn't have central banks to absorb external shocks. At the same time, peripheral countries tended to be very vulnerable to external shocks. They were usually kind of highly open commercially and dependent on capital flows. So they were very exposed, and that combination of being very exposed but having no way to absorb shocks to mitigate shocks would make it hard to be on the gold standard. And that's actually what we find when we look at the historical record. A lot of peripheral countries wanted to be on the gold standard because of the benefits it could offer. It could lubricate trade because it reduced or eliminated interest rate risk. It could provide more and cheaper access to international capital markets, as Bordeaux and Rockoff discussed, and it could provide financial stability, especially price stability, in part because it kind of tied the government's hands and forced it to kind of behave in a way conducive to exchange rate stability. In this chart, well, in this chart, we see the gold standard adherence record of several Latin American countries. And what we see is that most of them were on the gold standard for a short period of time. They would go on the gold standard, but inevitably there would be a crisis or a shock, and they would be forced to exit the gold standard and devalue. And so, for example, Argentina was on from 1867 to 1876. There's a crisis, it had to exit. They tried again in the 1880s. That experiment lasted only 2 years, and then they weren't able to go back on until 1900. And then some other countries also had kind of short stints, and then several countries were able to join in the early 1900s. And then, of course, all of them went off in 1914 when the system collapsed internationally because of World War I. There's an exception to this rule, and that is Uruguay. As I mentioned with the title slide, Uruguay was on the gold standard almost continuously from 1876 to 1914. This is the independent country outside Europe that was on the gold standard for longest, and indeed longer than many European countries. And it did it under these adverse conditions. It was a small, highly open economy. It had the highest exports per capita of the 8 largest Latin American economies, highly dependent on foreign capital flows, second highest foreign investment per capita in Latin America after Argentina. So very exposed. And then also it had no central bank during this period. Before 1907, it had multiple banks of issue, a decentralized note issuing system. In 1907, note issue was centralized in the hands of a state bank, but it wasn't really a central bank because it didn't have a lot of the functions that we normally associate with a central bank today. It didn't have formal lender of last resort capabilities or supervisory capabilities, or there wasn't even any bank regulation through which to act upon the banking sector. So highly exposed, no central bank. So what we do in this paper is we try to answer the question, the underlying question is, how did gold standard discipline function in the non-European periphery? And we do it by using Uruguay as a case study. And the specific questions we try to answer are, number one, how were external shocks processed by Uruguay's monetary system? And number two, did Uruguay's banking system adhere to the rules of the game as predicted by Alec Ford? And then the way we do this is by looking at interest rate pass-through. This is kind of the traditional approach to these kinds of questions. What was the impact of a shock in the Bank of England discount rate on the domestic Uruguayan discount rate? And then we look at not only interest rates, but also exchange rates. The uncovered interest parity condition suggests that there should be a relationship between interest rates and exchange rates. Whatever part of the shock is not absorbed by the interest rate should be absorbed by the exchange rate. So we examine that. And because of the long period of adherence, 38 years, we want to see how the relationship between these variables changes over time. I want to talk a little bit about the institutional underpinnings of the gold standard in Uruguay. For most of the 19th century, Uruguay had a bimetallic system. In 1862, there's a monetary reform. It upholds bimetallism, but it kind of redefines the gold content of the peso as 1.556 grams of fine gold. The first banks were founded in 1857. In 1865, there's a few banks in operation, and then there's like a banking reform that tries to kind of organize the system. This law requires banknotes to be convertible to gold, and only gold, not silver. And any bank that can't convert its notes will be liquidated immediately. So it establishes gold convertibility. It doesn't really put almost any other restrictions on bank balance sheets. There's no reserve requirements or anything like that. Gold convertibility doesn't last long after 1865. The 1860s are kind of a chaotic period for Uruguay, lots of internal strife. They get involved in this war in Paraguay. and the government declares inconvertibility of notes several times, usually to save this or that bank that is overextended and important for the government. In 1875, there's a major crisis. Inconvertibility is declared again. 1876, a military government steps in and they say, okay, we're going to do the gold standard, but for real this time. They reinstitute convertibility and they now demonetize silver. So silver after 1876 is only used for token fractional currency. So now Uruguay kind of meets all the criteria for being on the gold standard, and this lasts from 1876 to 1914. One detail, minting of gold coin was provided for in the law, but it never occurred in Uruguay. The gold that circulates among the public and that is used to back banknotes is gold coins from other countries. A lot of British, French gold coins, and then also from other Latin American countries that minted their own gold coins, like Argentina, Chile, and Peru. I mentioned that crisis in 1875. Only two banks survived that crisis, the Uruguayan branch of the London and River Plate Bank, and then a domestic bank, the Banco Comercial, that was kind of run by British merchants. Those banks are kind of very conservative in their credit practices. They're very oriented towards the gold standard. They do mostly discounting of bills of exchange and trade finance, and they kind of restrict credit. They don't offer longer term credit for industrial ventures or for longer term investments in the countryside. It's caused a lot of problems, a lot of complaints. There's calls for the government to establish a state bank with a large amount of capital that's capable of extending credit to other sectors. They finally do this in 1887. They found the Banco Nacional. This is founded by private capitalists, but it has government backing. The government kind of puts all the proceeds from its foreign loans in this bank. This bank lends money to the government. They have a close relationship. 1887 is also the beginning of a foreign investment boom and a domestic financial boom. So all banks expand credit, especially the Banco Nacional. This lasts 3 years and it ends in disaster, a major financial crisis in 1890, concurrent with the bearing crisis in Argentina. What sets off the crisis in Uruguay is the Banco Nacional, which has now become the largest bank by far, runs out of gold, and the government declares inconvertibility of its banknotes, and it says its banknotes are now legal, inconvertible and legal tender. They must be accepted at their face value. And what happens is that the other banks in the merchant community resist the government's attempt to take the country off the gold standard. And a couple of weeks after this law, they put out a communique that says, we're not going off the gold standard. We're not going to accept inconvertible Banco Nacional notes. We're not going to do business with anyone that does, and we're not going to do business with anyone that doesn't honor their contracts in gold. And this forces the government to backtrack. The government says, okay, Banco Nacional notes are not legal tender, and they end up liquidating the bank. And so the organized resistance of the merchant class and the other banks successfully puts Uruguay back on the gold standard at the same exchange rate as it was before. By the late 1890s, Uruguay is recovering, the financial sector is recovering, but the government says, we still need a state bank. There's still a role for a large state bank in Uruguay, and so they found the Banco de la República. This is intended to be kind of a mixed public-private bank. It ends up being only a public bank, state 100% state-owned. It appears that they kind of learned some lessons from the Banco Nacional experience, because this bank has a lot more restrictions placed on it. It has a reserve requirement of 40% of liabilities. It's prohibited from investing in the stock market or speculative ventures. This bank rapidly becomes the dominant bank, and it's actually, since the early 20th century, always been Uruguay's dominant bank and is still in existence today. In 1907, the government allows the charters of the other note issuing banks to lapse. And so in that year, the Banco de la República becomes the sole note issuer. Like I said, I don't think it can be considered a central bank because it doesn't have, all of the functions of a central bank, but maybe we could call it a proto-central bank. And so how did Uruguay stay on the gold standard for 38 years through all of these ups and downs? Well, I think it's this political economy issue that I already alluded to with this talk about the merchant class. The merchants in Uruguay were very powerful. They were involved in the import trade, importing goods from Europe and distributing them in Uruguay and neighboring countries. And they had their costs in gold, so they wanted their income to also be in hard currency. And so that's why they were so in favor of the gold standard. And they were strong enough to be able to impose their will, even when the government tried to take the country off the gold standard. Before we get to the results, I want to talk a little bit about how adjustment worked in a decentralized system. I think that there's two mechanisms at play. One is the balance of payments disciplinary mechanism that we all know. Faced with a rise in the Bank of England rate, there's a capital outflow that creates reserve pressure. People start exchanging their notes, withdrawing gold. And that eventually means that interest rates have to rise to stop that gold loss. And this mechanism is traditionally, we think of it as working very rapidly, and indeed it did, but it wasn't instantaneous. And there was some things that created a little bit of a margin, some financial frictions that created a little bit of a margin. And it's that margin that central banks could take advantage of to not raise their rates as much as would be required by the rules of the game, to keep their rates somewhat lower, perhaps slow the rise in rates also. That margin created by financial friction. So the balance of payments mechanism exists for a central bank country and for a decentralized system, but it leaves a little room to maneuver. In a decentralized system, you also have a second mechanism, and that's the interbank note clearing mechanism. Banks insert their notes into circulation by discounting bills or other lending. Those notes circulate. They end up in the hands of other banks, and those banks quickly return those notes to the original bank through interbank clearing, which is very rapid. Why? Because a bank had very little incentive to hang on to another bank's notes, because those notes don't pay interest and they can't be used as backing for new loans. So they would exchange those notes at the bank that issued them for the gold, and then you can lend based off that gold. And faced with a Bank of England rate shock, you'll have kind of this capital outflows, reserve pressures that might be uneven across banks. The banks that are hit harder, those banks will have to raise rates. Other banks have an incentive to keep their rates low for the same reason that a central bank does, because they want to, keep credit flowing to their clients and because they can gain market share. But what happens if they keep their rates low while other banks raise their rates? Well, now they'll have more of their notes in circulation than the other banks, and they'll be getting all of their notes back through clearing, which can happen bilaterally or through a clearinghouse very rapidly. And when their notes come in through clearing, they'll be losing gold, not through the balance of payments, but to other banks. Note clearing redistributes reserves among banks. And so what happens is that faced with a shock in the Bank of England rate, you have the balance of payments mechanism, which leaves a little margin, but you have the interbank clearing mechanism that kind of pushes the monetary system to the upper bound of that margin. It takes away the wiggle room. And that's why decentralized systems, we think, should have higher pass-through rate and faster pass-through. Now, there's limits to that mechanism. If all banks expand at the same time or fail to restrict at the same time, then the mechanism fails. It weakens because it depends on kind of a diversity of strategies by banks. When could this happen? Well, it could happen if banks, coordinated, which is very unlikely. Any type of coordination probably wouldn't last very long. But it could also happen during a financial boom. If you have a financial boom, especially if there's large capital inflows, lots of gold, banks can they're all expanding their balance sheets at the same time, and none of them are really forced to restrict in the face of a Bank of England rate shock. And so that'll weaken the interbank clearing mechanism and allow pass-through to be lower. And then if that continues, the whole system will eventually lose gold through the other mechanism, the balance of payment mechanism. That'll lead to a crisis. And during a crisis, we might also have a weakening of discipline for a different reason. During a crisis, banks a lot of times ration credit, so the interest rate no longer becomes the lever by which the volume of credit is set, and a methodology focused on looking at interest rates is going to kind of pick up lower pass through during those periods. So we would expect decentralized systems to have high and rapid pass through, but maybe not so much during a financial boom or financial crisis. And we kind of test this looking at Uruguay's historical record. We estimate a structural VAR to analyze transmission from the Bank of England to Uruguay, hikes or shocks in the Bank of England rate to the Uruguayan discount rate. Because these shocks could appear and disappear within the span of a year, we use monthly data from November 1876 to December 1913. We have the Bank of England discount rate, and then we have the Uruguayan market discount rate. This is the discount rate for bills of exchange discounted in local financial markets at the Bolsa de Valores de Montevideo. And then we also have the exchange rate. What is this exchange rate? It's the price of bills on London. Bills on London, most international trade was financed from London through bills of exchange. Because the London discount market was so deep and so liquid, and because the guarantees on these bills were so good, they were considered as good as gold, as some authors have said, and could be used as foreign exchange. So an exporter in Uruguay that draws a bill of exchange could send it to London to be discounted, or they could sell it in Uruguay to someone who needs foreign exchange, for example, to make a payment in London. And the stock market bulletin and the financial press published the prices of these bills of exchange, which fluctuated with supply and demand for these bills. And that's the exchange rate that we use. And the Uruguayan interest and exchange rates, we get this information from the stock exchange bulletin and from the financial press. So we do a 3-variable structural VAR with 2 lags. And we do compute impulse response functions to a shock of 100 basis points in the Bank of England rate. And we define the pass-through rate as the maximum response of the Uruguayan discount rate to this 100 basis point shock. So if the Uruguayan discount rate rises 30 basis points, that's a 30% pass-through. And our results are robust to alternative specifications. We try, instead of the Bank of England discount rate, Leonard's series of exogenous Bank of England monetary policy shocks. We get largely similar results. And we also try including New York money market rates in case, there was some interaction with New York as well that was important, and we really don't get different results. So what was the pass-through rate in Uruguay, and how can we evaluate it? We can use the results. Bazol, Monet, and Morris, the paper I mentioned, provide pass-through rates for European countries and the US. They use a much more sophisticated methodology, more variables, panel data, but they calculate pass-through rate in the exact same way. And so we can kind of compare. And then we've also re-estimated their results, just the 3 variables we use, and just our just simple VAR methodology, and we get largely similar results to what they got. So they give averages for core countries, France, Germany, Netherlands, Belgium, I forget what other country. They find a pass rate of 24%. Bank of England rate rises 100 basis points. these central banks raise their interest rate on average 24 basis points. For the European periphery in Japan, they find a little bit lower, 17%, because these countries, in addition to balance sheet management, they also sometimes used what was called gold devices, little impediments to gold movements, little capital controls that widened the gold points and made it so they didn't have to raise their interest rate so much. So these are kind of low results. The only country in their sample that didn't have a central bank was the US. And for the US, they find a pass rate of 49%. So it's more than double the results for the European central banking countries. For Uruguay, for our entire period, 1876 to 1913, we get a pass rate of 31%. And if we restrict to just 1891, 1913, which is what the Basol, Monet, and Morris paper does, we get a pass rate of 30%. So this puts Uruguay kind of in between the central banking countries and the decentralized US. Now, if we look at the time it takes to reach the maximum response for the central banking and for the US, it's 1 or 2 months. For Uruguay, it's 3 months. So on that dimension, Uruguay is kind of outside of the range of these other countries. So how can we explain this result? I think there could be two things going on. One is that maybe Uruguay is less financially integrated than other countries, than the US. And then the other possibility is that these long period averages hide variations, shorter period variations that then would have to be explained. In the first case, by all accounts, Uruguay was very highly financially integrated into the world economy and with London. It received large waves of foreign investment that coincided with the large waves of foreign investment emanating from Europe during the period. It was connected by undersea telegraph cable. By 1866, financial information traveled rapidly. Bond prices on the London stock market were quoted in the Uruguayan financial press with a delay of maybe 2 days. And the goods market seemed to be pretty integrated. This chart shows the correlation of monthly wheat prices for several cities. And so if we look at the first column, that's the correlation with London. And we see that Montevideo is not much less correlated than New York, and indeed more correlated than Oslo, Budapest, or Berlin with wheat prices in London. So we think that this evidence kind of means that we can sort of discard the idea that Uruguay wasn't financially integrated, and that's what explains the lower pass-through. So we're left with the idea that maybe there's important changes over time, and we test that by estimating the VAR with shorter periods, rolling windows, 8-year rolling windows, and we do them every 6 months through the whole period. And that's what we see in this chart. Each bar represents one rolling window, 8 years times 12 months. Each window is 96 observations. Darker colored bars are statistically significant at 95% confidence intervals, medium colored at 68%, and the light colored bars are not statistically significant. And what we see, and what I think is kind of our main result, is large variations over time. In some windows, the pass-through rate is 20% or even less, and in other windows, it is 50%, 60%, even close to 70%. So it's a lot of variation. In most windows, in 3/5 of the windows, the pass-through rate is above 40%. In the early 1880s and then in the late 1890s to the end of the period. So it's above 40% in most windows. What's kind of close to that result for the US? It's what we would expect for a country like Uruguay, high pass-through. When is it lower? Well, it's kind of lower in this period of windows that transit the late 1880s and early 1890s. And that is the period of the financial boom and the crisis and post-crisis that I described a minute ago. And we can see that in the banking sector balance sheet. This shows in blue, banking sector specie reserves, gold reserves, and then in orange, banking sector credit. And we see at the end of the 1880s this massive rise in credit, much faster than the increase in gold reserves. That's due to the foreign investment boom. And then we see the crash, the 1890, and then the total collapse in credit because banks restrict credit, and then the Banco Nacional, which is the largest bank, is liquidated. And what we think is happening is that during this period of massive credit expansion, the disciplinary mechanism weakens, banks cease to respond kind of very much to the Bank of England rate, and and pass-through falls. And then after the crisis, banks are credit rationing, and once again the interest rate isn't responding to the Bank of England rate for a different reason. It's because it ceases to become the lever with which the volume of credit is fixed. Now, our theoretical framework kind of suggested that margin, that wiggle room created by the balance of payment mechanism could lead to lower pass-through, but also slower pass-through. Here we see the number of months it takes for the Uruguayan domestic rate to reach its maximum. It's the same rolling windows. And we see that in kind of the more normal periods, the early 1880s, and then the late 1890s, early 1900s, we see rapid pass-through, 2 months and even 1 month. And that's what you would expect, high pass-through and rapid pass-through. And then we see that in this middle period of the boom and crisis, we see that the pass-through is not only lower, but a lot slower. It now takes 5 months for the interest rate to reach its maximum. One kind of thing that is surprising is that while the time it takes to reach the max is low in the early 1900s, after kind of the 1905, 1907, it rises to about 4 months. Why would that happen? Well, we see in this chart, towards the end of the period, we see credit kind of once again rising a lot faster than banking sector gold reserves. This is when the Banco de la República has now become the dominant bank in the financial sector of Uruguay, and in 1907 gains a monopoly on note issue, and this rising credit is mostly the Banco de la República. And so we think it's, expanding credit faster than what is normal in other periods where we see kind of this tight relationship between credit and reserves when you have kind of the more conservative private banks in charge. The Banco de la República is able to expand credit more rapidly. It doesn't show up as lower pass-through rates. Pass-through rates still remain high, but it does show up as slower pass-through. And so we don't know if it's on purpose or just a result of this kind of structural change, this institutional change, but concentrating note issue in the hands of one bank leads to this slower rise in the domestic interest rate. And then just to end, we also look at the exchange rate. This chart is for the same rolling windows. The reaction of the exchange rate to a shock in the Bank of England rate. Positive numbers mean peso depreciation on average. Peso depreciation is about 0.1%. It's kind of in line with what we see for other countries. Uncovered interest parity suggests that exchange rate reaction should be higher when the interest rate reaction is lower. And that's what we see. We see a rise in the exchange rate reaction to 0.25% depreciation in those boom and crisis years when the interest rate is not responding. We also have this funny result here, which is a peso appreciation in the face of a Bank of England shock. That's kind of weird and counterintuitive. Many of the windows are not statistically significant, but some of them are. What we think is going on there, this is a period of recovery, strongly positive balance of payments, as we can see in this graph that shows changes in country reserves, not banking sector reserves. We see strong positive balance of payments in the late 1890s, early 1900s. And then we also see falling risk premia, as shown by the spread between the Uruguayan discount rate and the Bank of England discount rate. It falls to about 2 percentage points and remains really stable in this period. And we think in this period of strong balance of payments, falling risk premia, which we know can kind of intervene with the UIP relationship. You get a Bank of England shock, you get a strong response of the Uruguayan domestic interest rate. And under these conditions, you can get a little bit of temporary peso appreciation. It's almost like there's a little bit of overshooting on the part of the domestic interest rate. Okay, to finish up, basically what we do in the paper is just try to answer the question of, do decentralized systems adhere closely to the rules of the game as suggested by Ford? The main findings: interest rate pass-through from the Bank of England to Uruguay is about 30% on average, kind of between gold standard central banking countries and the decentralized US. But I think the key result is this: the variability in pass-through over time. And we see that in kind of more normal periods, the early 1880s, late 1890s, early 1900s, we see high pass-through over 40%, close to that of the US. It's what you would expect for a country like Uruguay. And then we see a weakening of pass-through during the financial boom and crisis periods, which is also kind of suggested by our theoretical framework and the idea of this note clearing mechanism. When interest rate adjustment weakened, part of the shock was absorbed to a greater extent through the exchange rate. And then we have this institutional change around 1907 when the Banco de la República becomes the dominant bank and sole note issuer. Pass-through doesn't fall, but it does slow down. And we think that it has to do something with concentrating note issue on the balance sheet of the Banco de la República causes a slower rise in the domestic interest rate. And I think the main takeaway is that adherence to the rules of the game in these kinds of systems wasn't that mechanical. It depended on domestic financial conditions, and it depended on the institutional structure and institutional capacity. So it wasn't simply a matter of, is there a central bank or not? It's a little bit more complicated than that. And I'll stop here. Thank you very much.
Thank you, Gaston. Fascinating stories, lots of different pieces that individually make me wonder what was going on. I encourage everyone to put questions in the Q&A, but I'll start by asking I'll put together a couple of questions because they both kind of revolve around the question of, was there a proto-central bank? And so Paul Zarek wants to know what other functions the state bank that started in 1907 with the monopoly of note issue, what kind of other functions did that have? Did it have any role in price stability? And then Bill English is asking about whether or not there was a clearinghouse and whether the clearinghouse, as in, for instance, the US, took on central bank activities. So maybe you could talk a little bit more about, was there a proto-central bank?
The Banco de la República, so it's founded in 1896. It has a kind of a very large capital with respect to the private banks. And it's founded as a state bank, so it does kind of, provide financial services to the government, and the government has its accounts in this bank. And it rapidly becomes the largest bank. And so there are kind of anecdotal reports of it kind of being the discount rate leader, other banks following its discount rates, especially after it's been in operation for a few years. But it doesn't have like formal lender of last resort functions. It doesn't have supervisory powers over the banking system. There's no prudential regulation of private banks through which kind of, you could raise or lower reserve ratios, So I think it's debatable about how much of a central bank it was. That's why we use this vague term, proto-central bank, because I wouldn't want to go all out and call it a central bank. I don't think it was. Later in the 1930s, they turn it into a central bank proper. But I think at this point, it's not quite a central bank, but it is the kind of the center of the financial system. So that's why we use this term proto-central bank. And then as far as note clearing, I'm not quite sure if there was a clearinghouse because I haven't been able to find specific information on it. I know that in the 1920s, there's like a law that kind of regulates the clearinghouse, and it's from that law, it's not clear to me if there already existed kind of an informal clearinghouse that might have operated through the Banco de la República, or if no clearing was bilateral. All the banks were in Montevideo. They were concentrated in the old city, a couple of blocks from each other. They were, no clearing wouldn't. It's not like a large country where no clearing has to kind of, traverse long distances. So I'm not quite sure when they kind of got an official clearinghouse. I don't know if in this period there was a clearinghouse or not.
Were they branching banks?
Not really. The London River Plate Bank had a couple of branches in some cities in the interior. None of the other banks did. The Banco Nacional founded a network of branches that then all closed down when it collapsed. And then the Banco República kind of reinstituted those branches. So by 1915, there's branches in all of the provincial capitals. But for most of the period, banking is kind of really concentrated in Montevideo.
It's interesting you say you don't have clearinghouse statistics, because in Canada, there's more data on the amount of clearing that goes through in the different cities on a weekly basis than almost any other metric. And I don't know what to do with it, but there's vast amount of data on clearing. So it's interesting that
Interesting.
Yeah.
Interesting. Yeah, we don't have clearinghouse information until the 1920s. We don't really have information on the use of checks also until the 1920s, because that's when there's like a law passed kind of organizing the checking system and a law passed organizing the clearing system.
Eugene White has a question about the comparison between Uruguay and Argentina. And it's sort of an obvious question, very similar environments. And to what do you attribute the stability, if you like, of the gold standard in Uruguay and instability in Argentina? And is it, in particular, he's thinking, should Argentina have been split into different places and so that it would have been more homogeneous units? But what are your views about Argentina's experience compared to Uruguay's?
I think maybe one could give a lot of different answers to that. I'm going to go with this political economy answer about the merchants, the power of the merchants in Uruguay, and them being relatively less powerful in Argentina vis-a-vis the landowning class. So in Argentina, you have the cattle ranchers who have incentives to not be on the gold standard because they have the opposite incentives of the merchants. They have their income in gold, and then they have their cost in pesos. And so if you're not on the gold standard and your currency is depreciating, that increases your profits. And so there's a lot of economic historians and a lot of contemporaries commented on this, that the landowning class in Argentina, and it's also in Brazil, the coffee growers in Brazil, were kind of against the gold standard because they benefited from a depreciating currency. In Uruguay, the landowners are important, but you also have this kind of large merchant class, which is kind of outsized for the size of the country, because they use Uruguay as an entrepot to bring goods into neighboring countries, often illicitly avoiding paying tariffs. So part of their business is smuggling. And they're relatively more powerful, and they're able to impose their will, even as we saw, even when the government tries to take them off the gold standard, they're able to say, no, we're staying on the gold standard. Where in Argentina, I think that the cattle ranchers were relatively more powerful. And so that's why they weren't on the gold standard for a long time, or they would go on and then there wasn't a lot of resistance when they would go off the gold standard. And as far as whether Argentina should have been split up into smaller countries, if that would have made it more successful in maintaining the gold standard, I don't really want to venture an answer to that. That seems a little bit more complicated than I'd have to think about it.
Okay, thank you. Coming back to the 1890, and Paul Zarek has another question about the bankruptcy of the Banco Nacional and whether that was the role of the Bering crisis in Argentina there versus domestic factors.
Whether what happened in Argentina impacted on Uruguay, is that the question?
What happened in Argentina, the Bering crisis more generally, what was...
Both countries experienced a major foreign investment boom at the end of the 1880s. In both countries, Barings Bank was heavily involved. It was the agent of both the Argentine and the Uruguayan government in London, so it was in charge of floating government debt of both countries in London. A lot of other financial actors operated on both sides of the River Plate. So like the London and River Plate Bank had its main branch in Buenos Aires, but another branch in Montevideo. George Drabble owned railways on both sides of the river. And so you had a lot of the same financial actors. You had a financial boom in both countries, and they both have a crisis at the exact same time. The day Argentina defaults on its debt, it's the same day that Uruguay declares inconvertibility of the banknotes of the Banco Nacional. Which one did it first, and which one was like, oh, I'm going to take advantage of this chaotic situation and also declare default? I don't know. So I think one way to look at them is that it was kind of the same boom and the same crisis in the Rio de la Plata, with two countries that had a lot in common, but they had one thing that was different, which is their monetary policy. In the 1880s, Argentina was not on the gold standard. It had a depreciating paper currency. Depreciation was occurring kind of exponentially towards the end of the 1880s. Inflation also, where Uruguay was on gold, wasn't quite behaving as a gold standard country should, as we saw with this graph that shows, the massive credit expansion, but it was on the gold standard. So they have this difference, but I actually have a chapter of my thesis that focuses on that compares the crisis in both countries and kind of through the lens of the different monetary policy, and kind of shows, what the differences were. And then so I think they can be looked at as one boom and one crisis. Or if one wanted, you could say, well, there was contagion from Argentina to Uruguay, but they were both countries that had, were massively indebted, interest costs for the government. Uruguay eventually defaulted also in 1891. Interest costs for the government had skyrocketed for both countries. Both countries had kind of run out of gold. So I think you would look at it in more than one way.
Thank you. I'm going to interject. There's another question in the Q&A, but while you've got the graph up here, I was intrigued by the run-up of credit at the end of the 1900s. And that looks like it's going to generate a crisis if there hadn't been a war kind of coming along. Do you have thoughts about that? That just seems inconsistent with gold standard behavior in general.
I think we'll never know because World War I, kind of put a stop to that experiment, but it could have been likely, and we even see banking sector gold reserves start falling after 1909. Credit still increases, and it falls from 1912 to 1913. There's like a little financial problem going on even before 1914 that hasn't really been well studied, that one could look at, and I think that maybe you're right. Maybe this would have ended in going off of gold or another crisis if it hadn't been for World War I.
Let me ask Gaston Jabri's question. I'm just going to read it. About the volatility in the pass-through rates and the moving window estimations. To what extent do you think the degree of concentration in the commercial banking sector, rather than the absence of a central bank, influenced the effectiveness of the interbank clearing mechanism? Did the system rely on a sort of leader bank or a few leader banks to stabilize the clearing process?
That's a very interesting question. Thank you. I think in the late 1870s, early 1880s, there's only two banks, two note issuing banks, the Banco Comercial and the London and River Plate. They're both kind of the same size. So I don't know if one of them could be considered a leader. And I think you could possibly have, if you only have two banks, you could possibly have kind of coordination between the two of them, and that could affect pass-through. I don't really have any other direct evidence for that. And but pass-through rates are actually kind of relatively high, except for in these kind of very early windows. Then during the late 1880s boom, there's a bunch of other banks founded. A lot of them are note issuing banks. Um, um, and so there you have more banks. You have the Banco Nacional becomes the dominant bank. It becomes the leader, I guess. But I don't know if other banks are following it or not. And then after the crisis, the Banco Nacional is liquidated along with a few other banks. And you have only three banks that are note issuers, the London River Plate bank called the Banco Italiano, and then the Banco de la Repubblica in 1896. The Banco de la Repubblica does become the dominant bank, and there's kind of anecdotal evidence that after 1900 it kind of was the leader, the interest rate setter. But it's only anecdotal evidence. We don't have information on individual bank interest rates for basically any bank throughout this period, which is unfortunate, and it prevents us from kind of answering that question more directly.
Thank you. A question from Stefano Battalossi. Do you have any insight on the possible role of foreign banks in Uruguay in the transmission of shocks from London? And in particular, he's thinking of the recent paper by Kisling and Molteni in Cleometrica on the relationship between the London money market and credit supplied by German banks in Brazil.
I mean, I don't have information that would allow us to kind of look at things the way that they did. That there were a lot of foreign banks, there were a lot of London banks. There was the London and River Plate Bank, the London and Brazilian Bank, a few other London banks founded in the British banks founded in the late 1880s. So at times, foreign banks were always important during this period. Not necessarily half of the market, but maybe 1/3 of the market. But I don't know a lot about their specific kind of relations with London, and if those were different than for the domestic banks. I mean, I assume they were, but I don't have a lot of information on the specific banks. I just have kind of general for the London and River Plate kind of balance sheet information, capital account information, but not a whole lot else.
Okay, thank you. And I think Rui has a question that he can ask himself.
I can indeed. So thank you very much for bringing this paper to our series. Just to give a bit of work to Nectarius, I want to ask a couple of questions about the empirical specification, right? So you motivate this paper as going back to the old literature on the rules of the game, but actually to me it looks more like a paper that relates more to the global financial cycle as defined by Len Ray a couple of years ago, right? So this idea that emergent markets, irrespective of their exchange rate regime, are beholden to what happens with monetary policy and the financial sector in the US, right? Here, we replace the US with the UK. So implicitly, you assume that the only source of exogenous shocks is the Bank of England interest rate, the bank rate. But, exogeneity you can find in many other locations, right? For instance, there might be terms of trade shocks, right? Uruguay was an exporting small open economy, very dependent on the export of a narrow group of commodities, didn't control the price, was price taker. So terms of trade shocks could be another source of exogenous variation for you to try on your VAR. Similarly, supply shocks. Right, so I know admittedly very little, right? But I guess Uruguay mostly exported cattle and derived products from there, right? So any kind of ringed pest, for instance, right? It would be interesting to see whether there was a leeway for the local banking sector, more or less concentrated, to actually try to absorb the shock by cutting interest rates, for instance. Could they do it? Right. So this is the specification is the same, but the exogenous shock would be different. And then on the IRFs that you estimated, so you always quoted time to the maximum IRF, right? But I think it would be also interesting to see time to insignificance. So for how long does the shock remain significant, right? And there I think it's longer and surprisingly so, very, very long IRFs, right? So can you speak to that? Thank you.
Nectarios, do you want to answer this?
Yeah, thank you, Rui, for that question. Indeed, we use a small VAR with 3 variables, but we also try to check the robustness of our results by including the Leonard shock. So we do two kind of exercise. The first one is to include it instead of the bank rate, and the other one is to include it with the bank rate. And the results remain qualitatively, at least qualitatively the same. So we are quite confident about this. Now, regarding the duration of the shock, of the response, and how long it is significant, that's a good point. This is something we should think harder about and investigate more. Yeah, thank you.
Yeah, I mean, it may be as easy as a bit of unit roots that you haven't controlled for. But anyway, sorry.
Okay, I'm going to, if there's further discussion there, we can continue it. But this is the end of the hour, so this is the end of the formal part of the session. I would like to thank Gaston and Nectarios for their paper. And I also want to remind everybody that in 2 weeks, we'll have a paper by Sarah Quincy from Vanderbilt. She'll be speaking on when capture fails, political realignment and bank entry regulation in the Great Depression. So that's 2 weeks from now, and look forward to seeing everybody then. But Gaston and Nectarios will stay for another 10-15 minutes if there are further questions. So thank you all. Gaston, I have a sort of a couple of questions. One is actually about the framing at the very beginning. So I don't think it's because as you started, it seemed to me that you were sort of saying a central, the periphery is a country without a central bank. I just kind of got lost in where the US, Canada, like whether is the US peripheral, and you're surely not, right? And so it was the US didn't have a central bank, Canada didn't have a central bank. So I thought somehow that you had phrased it that they were peripheral, and obviously just not having a central bank doesn't make you peripheral. So I just wondered if do you remember at the very beginning?
I mean, I think that whether the U.S. is peripheral, some people might consider it peripheral in certain contexts, and some people might not. The point is that it doesn't have the U.S. didn't have a central bank, and so it's really the only decentralized system that has been studied in depth, and it's the only one that shows up in this Bazol-Monet and Morris paper where they have these nice pass-through rates that we can compare to. So right. I don't know if it's peripheral or not, but it's a decentralized system, and it's something that we can compare Uruguay to. Uruguay is peripheral, and it has this decentralized system, at least until 1907. And it has this long period of gold standard adherence. So it makes it kind of an ideal case to study alongside the US of these decentralized systems.
Yeah, and I think at least relative to Canada, it has good interest rate data, or at least better interest rate data, and that's always been a stumbling block in looking at the Canadian kind of experience.
Yeah, finding interest rate data isn't the easiest thing for for these countries, where Nectarios and I, along with Matias Moris, we're looking for kind of replicate this for other countries in Latin America now. And it's not so easy to find interstate data for some countries. So for Uruguay, yeah, it's kind of nice that we could find these long series. I just wanted to respond a little bit to Rui. I think part of the problem with kind of testing other supply shocks and stuff like that is that it'd be really hard to get like monthly data for anything else that isn't these financial variables. It's just not really available for Uruguay.
Price data, right? Go to The Economist.
Yeah.
Right.
Nathan
Sorry.
has
I'm out of line. Sorry.
Right. So you mean for
Nathan,
like
you have a question?
specific events to see if there's specific events, right? Yeah, that's a good idea. That's actually a good idea, Rui. Thank you.
Thank you, Gaston and Nectarios, for the very interesting paper. The one thing, just a clarification in terms of the gold standard system that was the gold standard they adhered to in Uruguay, which I'm of course not 100% familiar with, but what was the role of sterling reserves as opposed to gold in the Uruguayan banking system? Because at least for my incursion into bearing records and stuff like that showed there was quite a lot of credit given in pound sterling that of course were convertible to gold. And so what I mean, I think that what the graph you showed is gold reserves, I think, was it?
Yeah.
And to what extent sterling reserves were also sort of a buffer or something that was equally or less or not. I mean, I'm not familiar with Uruguay. Another kind of anecdotal, just a thing that is, did you ever look at the, again, it wasn't clear from the presentation, at the London River Plate archival data,
Yeah.
UCL? Yeah, so you consulted those.
Yeah, both at UCL and at Lloyd's. That archive is split between
split.
UCL.
Yeah. So
I went to both places and got what I could. As far as sterling reserves in London, there's like anecdotal evidence that those were, banks had those, obviously, especially more towards the end of the period. And then it's not always clear from the bank balance sheets whether they include those in what they call the encaje, which is their reserve, or not. I think they usually are, but sometimes not. It's not always clear. And so it's hard to know how important they were.
Eugene has a question. I think we'll unmute and Eugene can ask his question.
I guess I'm supposed to, I can hear me now?
Yeah.
Yeah.
Good.
Okay, good. So I want to push forward a little bit on my previous question, because I think the literature on optimum currency areas is helpful for gaining a bigger view of what's going on. Hugh Arkoff has this paper, as was the US in an optimal currency area in the 19th century. And the point of that is the economies, it's the European Union question, have very different, react differently to shocks. It's much more difficult to carry out policy. Uruguay is a small country because it has, and it appears to have like well integrated as optimal currency area. The problem is Argentina, and there's really a question is because these countries are formed rather chaotically in the 19th century. So it may be difficult for it to stay on or to carry into that policy because you have very different economies in those areas. I mean, maybe, and this is a sort of counterfactual question, maybe it should have been a country which is the Banda Occidental del Uruguay, province of Buenos Aires, because they still would have exported wheat and cattle. But I think that it's some insight as to how, if you have all these different regions and different elites, it's much more difficult to carry out policy. And that's probably partly the problem of the US for a long time.
Mm-hmm. Yeah. I don't know a whole lot about the optimum currency area literature. I think yes, but I think for Argentina, yeah, there's like a diversity of situations. Buenos Aires is very kind of, internationally oriented. You have certain parts of the country that are, that have this export economy, cattle ranching, and then starting in the 1880s, like wheat farming. But then other parts of the country, like the north, that are producing for internal trade. So you have like sugar and wine being produced in in Mendoza and in some of the northern provinces, that's for internal trade. And so those are very different conditions and require different, monetary
Well, the
response.
adjustment mechanisms to a shock, the adjustment to a shock is different in each region according to its composition of its industries.
Exactly. So yeah, so I mean, I guess it's possible that Argentina wasn't an optimum currency.
So the question is the success of policy or the success of the political entity, the structure of it? Anyway, I'll leave it at that.
Right. But yeah, I guess I don't know a lot about this literature. I don't know enough to give like an informed answer on this.
Read Rockoff's paper. Rockoff said, looks and John Landon Lane look, and they find that the U.S. was not completely integrated markets well into the 1920s.
Right.
Which explains a lot of the political economy.
Right. Okay.
I have one question that I'll just throw, and I think Rui was going to mention this, but it was about prices. And the data where we do have data is prices and the sort of older literature about price specie flow, and you don't use price data at all, I think. And it's just a bit surprising that wouldn't tell you something about how the gold standard worked in that period.
You mean like a general price level?
Yeah, like a wholesale. I mean,
right.
There'd be two different ones. I presume there'd be one that would be much more export prices because it'd be wholesale price index, but also if there was something like a consumer price index. I don't know if you have that kind of data. Rents.
We definitely don't have monthly, right? Like a monthly CPI or anything like that. So we don't have anything that we could like use in a statistical exercise with the financial variables. We do have a CPI, like an annual CPI that is not very good and kind of shows what you would maybe kind of expect. Uruguayan prices, because it was on the gold standard, kind of followed international prices or British prices. They kind of fall kind of through the 1880s and early 1890s, and then they begin to rise. And the fall is a little bit more dramatic, and so it's a rise, but it kind of generally tracks what's going on internationally. But we don't have good price information. That CPI is very precarious.
Okay. Is there a seasonal in the interest rate?
Yeah. Okay. Yeah. I didn't show this in the presentation, but I can show it now.
Well, Angela, why are you asking about seasonality in the interest rate?
Just because I wondered if there is a big seasonal factor, whether you took it out when you did the VAR, and also in the US, seasonals have a big influence on sort of domestic bank stability. So
this upper graph shows the two interest rates: the Bank of England rate in blue and the Uruguayan interest rate in orange. And as you can see, there's kind of this first period, there's a lot of variability, and this is kind of seasonal here. And then it kind of in the 1880s, it kind of stabilizes, or the variations become smaller. And I think this is because there's a massive increase in the number of banks, so the greater elasticity of credit kind of takes away the seasonality. And if I recall correctly, Nectarios, we did kind of test. Try to deseasonalize the series and do tests, and it didn't really seem to make much of a difference.
Yes, indeed. I mean, statistically there is a seasonality in this part of the sample, at least evidence of that. But even after taking this out, the results don't really change much.
Okay, it's actually striking how much the seasonality is reduced after the early 1890s.
Yes, indeed.
Okay, I'm not seeing further questions. Wait, I have one question from Relis Avaro. In the Flandreau jobs metrics of the classical gold standard, the US is not part of the key centers issuing international currency. Do you look at the course of the exchange for Uruguay? I'm not sure, Melis, is that clear to you? Do you want me, Melis?
I'm sorry, can you, I didn't want to hear.
Do you look at the course of the exchange for Uruguay in relating to
I
the
can
front row
unmute-
jobs metrics.
I can unmute Miley, so maybe she can
Okay, thank
ask
you.
the
Yeah.
question.
Milas, maybe you could ask your question.
Yeah, hi, can you hear me?
Yeah.
Yeah.
Yeah, thank you. So yes, there is this paper where they look at connection of money markets, looking at the cost of the exchange. So looking at which currencies are being quoted on the local money markets. And so I was wondering whether you had this data and that could show whether London was the key money market, or whether maybe Paris, Berlin, or indeed New York would be regularly quoted on the Uruguay money market.
You mean if which currencies were quoted in Uruguay, in Uruguay's stock market bulletin?
Yeah,
Yeah.
exactly. That's a methodology that this paper have been using in order to show the connections of money market during the classical gold standard.
Right. Yeah. Uruguay quotes lots of different financial centers. That London is always at the top of the list, but then there's always Paris, Berlin, Amsterdam, sometimes Spain or Italy, and then usually Argentina and Brazil. That's what's quoted. And then towards the very end of the period, New York appears, but only towards the very end of the period. And then obviously Uruguay is not quoted by anyone else that I know of.
Oh, that's interesting. I was just checking Marcus Dento's handbook of exchange rate, and the only quotations they have from Montevideo is sterling, right? So you guys are showing that it's wrong.
Right. Yeah. In
That's another advantage.
in the stock market bulletin, in every issue, there's a table that has at least 5 or 6 financial centers quoted.
Okay.
Okay, we are at 10:15, so I'm going to draw events to a close. But just thank Gaston in particular for presenting, and Gaston Nectarius for a fascinating paper. And thank you all for participating. We'll
Thank you
see
for the
in a couple of
opportunity.
weeks.
Thanks for sharing, Angie.
Thank you very much.
Thank you, guys.
Thank you.
Thank you
guys.
for your
Bye-bye.
question. Thank you. Bye.